All right, today we're going to do a real quick recap of all the major graphs that you need to know for this year's AP Macroeconomics exam. So just remember that last bit on foreign exchange markets and international trade in general, you shouldn't see too much content on the 2020 exam because they said they were going to cut out much of that unit. So we're going to focus mainly on those first four core units. All right, so we're going to kick it off with what you looked at in the first couple Loanable review packets. You looked at this example of a production possibility frontier. I just want to review those points that you see. These are nice and easy points to remember. The E, the U, and the X. So, of course, this production possibility frontier is bowed outward from the origin. It's concave to the origin. We assume that this economy can only produce two items, the beach balls and the ice cream cones. Any point along that curve, whether it's point E or any other point that would fall on that concave to the origin curve, represents full productive efficiency and fully employed resources. So therefore, if there's any point inside the curve, like point U, that represents unemployed resources, whether it's unemployed labor, unemployed land, unemployed capital. Point X indicates a point that would be impossible to attain right this second. However, in the future, this PPC that's concave to the origin can shift outward if there's economic growth, and then we could get closer to a point like point X. We can also consume beyond our production possibility curve with international trade through the Ricardian model, the stuff with opportunity cost, which is still part of this first unit. So the concave to the origin, production possibility frontier, that bowed outward shape, that indicates increasing opportunity costs, and that means that the resources to make beach balls and the resources that are needed to make ice cream cones are not perfectly substitutable. So as we move along our PPC to increase the amount of ice cream cones that we're producing, we're going to sacrifice more and more beach balls at the margin. If you see straight production possibility frontiers, that just means that the opportunity costs are constant, that the resources used to make beach balls and ice cream cones are perfectly substitutable. So here there is no change in the opportunity cost as you move along sand, land, and surf kingdoms PPCs. If you're given these constant cost PPCs and the maximum production values, like the 50 and the 25 beach balls for surf kingdom and sandland, this would be an example of one of those output problems. So therefore, if you needed the opportunity cost of beach balls is your denominator. If you were calculating the opportunity cost of an ice cream cone, then the ice cream cones are your denominator. Now, if they told us it took 50 people, or 50 resource units, or 50 minutes to make one unit, then with those input problems, you would make sure you put the beach balls in the amount of resource units in the numerator. So remember, output problems, denominator, input problems, numerator. So if for trade to be beneficial for surf kingdom and sandlands in this Ricardian model, you want to circle whichever economy has the lower relative opportunity cost. So for surf kingdom should specialize in beach ball production because they have a lower opportunity cost compared to sandland, who would sacrifice 2 ice cream cones for each beach ball that it produces. So that means that surf kingdom would actually export beach balls if these two countries were to trade. In order for trade to be beneficial, surf kingdom would need to receive more than 1 ice cream cone for every beach ball, for each beach ball per unit beach ball that it exports. On sandland's side, sandland has a smaller relative opportunity cost for ice cream cone production, So therefore, Sandland would export ice cream cones if they were to trade. Sandland would need to import more than 1/2 of a beach ball for each ice cream cone that it exports. This is that I over E rule that we worked with earlier in the year. I over E should be greater than the opportunity cost of what the country is exporting. I over E should be greater than the OC of the E. Cool? Nice. All right, supply and demand. This applies to macro and micro, of course. This is just your classic market in equilibrium. If the price was to be under $50, that's a temporary shortage where these points along the demand and supply curve would move. So no shift of the curve if there's a change in price. So if there's a $20 price of video games, that temporary shortage would eventually disappear as market forces would push us back up toward the equilibrium price of $50. If we had a temporary surplus, the prices of video games were too high, then market forces would eventually push us down. Where the quantity supplied is greater than the quantity demanded, eventually the market equilibrium would be restored where the supply equals the demand. Make sure you remember your shift factors. We used timer for demand. We used rat nest for supply. Whenever there's an increase in demand, equilibrium price rises, equilibrium quantity also increases. If there's a leftward shift of demand, equilibrium price comes down, equilibrium quantity would also come down. So make sure you remember your taste, your income, your market size, the prices, the expectations of prices, and then the prices of substitute goods like butter and margarine or beef and pork, and the prices of complementary goods like spaghetti and meatballs. Supply, we used rat nest, like resource prices, alternative output price changes, technology, number of sellers, expectations of prices, per unit subsidies, and per unit taxes that are geared toward production. So any rightward shift of supply would result in lower prices and higher output levels in a market, and a leftward shift of supply would give us higher prices and lower output. If we have dual shifts and we don't know the magnitude of the shifts, which is typically how it's presented on the AP exam, if there's a dual shift, one of the variables, the price or the quantity, will be indeterminate or ambiguous, as the Krugman textbook says. So if there's an increase in supply and an increase in the demand curve, we would say the price could go up, the price could go down, or the price can stay the same. It's ambiguous, it's indeterminate. However, with an increase in demand and increase in supply at the same time, the quantity in the market would definitely increase. More demand, more supply, more production, more buying. So this is just a summary of the dual shift case. Remember, I had this on the board, way back in end of September or so. So when demand and supply move in the same direction, it's price that's indeterminate. And when supply and demand move in opposite directions, the quantity in the market would be indeterminate. All right. This pertains more so toward the micro exam. But if we have the price ceilings and the price floors established in a market, price ceilings will cause shortages if they are below the market equilibrium. So that would reduce the level of producer surplus that I shaded in. That's more of a micro thing. It's going to create deadweight loss, as you see, and it's going to change the size of the consumer surplus in the market. So there's a little rectangle that used to be part of the producer surplus that's going to now shift toward the consumer. And then, of course, you have that triangle that points toward the free market equilibrium that represents the deadweight loss when you have a price ceiling. This is the classic example of price controls in housing. Then the bottom right, we have a price floor. Classic example of that would be a minimum wage. Minimum wage would create a surplus of labor. You'd have a lot of people looking for work, which we just talked about with the factor markets. And you wouldn't have as many workers demanded by businesses. So it creates a surplus of labor, which also generates deadweight loss within the market. So you have to remember, ceilings to be binding and effective have to be below the market equilibrium, and price floors, for them to be binding and effective, must be placed above the market equilibrium. Circular flow model, not something that I'm assuming they're not going to ask you to draw this. I haven't seen them ever do that, but they could definitely make references to it. So you have the two markets, your resource market and the product market. I put the resource market on the top. I put the product market on the bottom. That's just because that was the mood I was in. So there's really no rule, there's no law as to where the product markets and factor markets have to be positioned, and same with households and businesses. So here the monetary flows are moving clockwise. Businesses incur costs. In the factor market, that becomes income, goes to the household. Households will consume. In the product market, that becomes revenue to the businesses. Then in the factor market, the households are supplying the economic resources, those economic inputs, and those inputs would be used to create goods and services in the product market. We can throw the government in the middle, as the government's going to tax households and businesses, but also provide goods and services to households and businesses. Quick little recall of the business cycle. The ups and downs of real GDP over time is what this is illustrating. So we have economic expansions as the real GDP rises and prices rise till we hit the peak, and then a recession begins as we come over the peak where the real GDP declines for at least 2 quarters, consecutive quarters, 6 months, and that would be our recession, the economic contraction. Then the economic recovery begins after the trough as we see an uptick in real GDP. We have that upward sloping line to represent the long-term trend of long-term or long-run economic growth. All right, let's get to the meats of AP Macro. So now it really boils down to ADAS, which is a major model on the AP exam. So we're going to really focus on ADAS, money market, loanable funds, Phillips curve. Those are probably going to be the 4 power players going forward. So here we have a fully employed economy. This is an economy that's like at the peak of the business cycle, where short-run AS intersects the aggregate demand curve and the long-run aggregate supply curve. Remember that Q sub F represents full employment. So if you are sketching this out on the AP exam, make sure you write real output or real GDP on the x-axis. Make sure you write price level, not just price. If this was AP Micro, you would just write price and output on most of the graphs, most of the models that you need to know. But for macro, you have to indicate that you're working with price level and you're working with real output, real GDP. So you're probably going to start off with either a long-run equilibrium like you see here, kind of like what you did on that graphing quiz back in November, fully employed economy, or a recessed economy, or an economy with demand pull inflation. So long-run equilibrium looks like that. A recession starts off with the short-run equilibrium to the left of the long-run aggregate supply curve. So here we're saying that there is a lot of unemployed resources that are looking to go back to work, which in the long run, they will be fully employed. Of course, the government can take action in the short run in the Keynesian model to try to help the unemployed resources by boosting government spending or cutting taxes, because that would shift aggregate demand. If the economy was self-correcting from a recession, and there was no government policy enacted, we know that workers or the labor market's inflation expectations would fall, and workers would eventually take lower nominal wages, which would reduce the cost of production and shift the short-run aggregate supply curve to the right. That would bring down the price level and increase output and restore the economy to full employment in the classical model. So when you're working with the short run, Keynesian changes in ADAS, a lot of times you'll be shifting aggregate demand when it comes to policy. When it comes to long-run self-correction, in the absence of government policy, you'll shift aggregate supply back toward the long-run equilibrium. Long-run aggregate supply, the Q sub F. This would be an example of demand pull inflation. So here we have high prices, very low unemployment. So here, unemployment rate could be lower than the natural rate of unemployment because Q sub F, our potential real GDP, represents that natural rate of unemployment. In this case, if we're concerned about high demand pull inflation, the appropriate government policy would be to cut back on spending and to increase taxes, increase income taxes, and that would put downward pressure on aggregate demands and help the economy in the short run. In the long run, the self-correction is that workers would demand higher wages as their inflation expectations rise, and then that would shift aggregate supply, the short-run AS curve, to the left and restore the Q sub F. So here's a rightward shift of aggregate demands. This could have been brought on by an increase in consumption, an increase in investment spending, an increase in government spending, or an increase in net exports. Brings up the price level, as measured by the GDP price index, increases the real GDP, and it lowers the rate of unemployment. Here's a leftward shift of aggregate demand, starting from demand pull inflation. This can be caused by a decrease in consumption, a decrease in investment spending, a decrease in government spending, or a decrease in net exports. Prices come down, output decreases. All right, here is a rightward shift of aggregate supply. So if there are lower resource costs, lower factor costs, across the board in the economy, large scale, that would shift the short-run aggregate supply curve to the right. This would bring down the price level and increase the real GDP. This would also be an example of the long-run self-correction because in the long run, in the classical model, prices and wages are flexible in the downward direction. And then here is a decrease in the short-run aggregate supply curve. So anything that causes higher costs of production, that could be, the government, taxing businesses across the board on a per unit basis. That could be workers increasing their inflation expectations. That would be consistent with the leftward shift of the short-run aggregate supply curve. It can even be something like productivity declining or slowing down the growth rate of technology. So leftward shift of aggregate supply, higher price level, lower output, higher unemployment. Here's your money market. Money market we typically use when we're talking about monetary policy. Remember when the Fed would buy bonds and sell bonds, you did an entire project on it. Those videos were a lot of fun to watch. Wish we had more time to watch them in class, of course. So here we have our equilibrium supply and demand of money. So we say that the supply of money is perfectly inelastic, or it's vertical, because it's set, it's fixed by the central bank, the Federal Reserve. The price of money is illustrated or shown as nominal interest rates, short-term interest rates. The demand for money is just downward sloping demand curve, and it's the money market, so the x-axis is the quantity of money. So typically as the economy expands, as there's more demand for goods and services and consumers are spending and spending and spending, that could increase the demand for money. And if the supply of money stays constant, that would naturally bring up interest rates. So typically inflation, higher price level, would cause more demand for money, and that would bring the price level up. And vice versa. Now, a lot of times on the College Board's exam, they're really testing you on how monetary policy affects the supply of money in the short run. And that has to do with the buying and selling of government bonds by the central bank. So when the Fed buys bonds, remember, buying bonds expands the money supply because the central bank is putting more money into circulation, putting more money into commercial banks. Commercial banks will now have more that they can lend out to the public. So if there's a greater supply of money, the way that the banks will attract borrowers is by lowering their nominal interest rates, lowering the interest rates on those loans. So as the Fed buys bonds, it expands the money supply. That brings down nominal interest rates and increases the quantity of money that's circulating throughout the economy. So those lower interest rates would encourage more consumer spending and more investment spending, and that would then link to an increase in aggregate demand in the ADAS model. So expansionary monetary policy expands the money supply, which expands aggregate demand due to lower interest rates. So this would be most appropriate during a recession. So that blue box just represents that short-run Keynesian transmission mechanism of expansionary monetary policy, the cause-effect chain of monetary policy. A tight or contractionary monetary policy is most appropriate during an inflationary gap in the economy, like demand pull inflation. If we're concerned about high prices, the Federal Reserve can take some of that money out of circulation and put it on its balance sheet. So when the Fed sells bonds, it's taking money out of the financial sector, making money more scarce. So if people want to borrow money, if the private sector wants to borrow money from banks, they're going to have to pay a higher price, and that's a higher nominal interest rate. So that would reduce the amount of consumption and gross investment in the economy, which would decrease aggregate demand, which would bring down the price level, result in less output, and increase unemployment. So make sure you're comfortable with that going into the AP exam. Buying bonds is expansionary monetary policy by the central bank. Selling bonds is a contractionary monetary policy by the central bank. Word. All right, more fun with the PPC real quick. When it comes to long-term economic growth, we can show that with an outward shift of the production possibility frontier. This can be caused by, advances in technology, productivity, health, education, training of the labor force, growth of capital stock of capital stock. It's a supply of all the capital goods in the economy that can help grow the potential of the economy. And that's what the PPC represents. If there's a rightward shift of the PPC, there's also a rightward shift of our potential real GDP, as shown by the long-run aggregate supply curve. So there is a link between the PPC shifting and long-run aggregate supply. Here's the loanable funds market. Typically, we use loanable funds market for showing how fiscal policy through the crowding out effect can kind of mess things up with interest rates, real interest rates, and also how changes in savings habits by the private sector can be good for long-term growth. So if households are saving more of their income, there's a greater supply of funds that banks can lend out. So if there's a greater supply of loanable funds, real interest rates come down, those longer term interest rates come down, and that encourages more investment spending, more growth of capital stock, and therefore a rightward shift to the PPC and the long run aggregate supply curve. So while this idea is similar to what we just looked at with the money market, it's important to note that we use real interest rates for loanable funds, and we have an upward sloping supply curve for loanable funds, because the Federal Reserve isn't the only thing in control of the supply of loanable funds. In the money market, we're assuming that the Fed can control the supply of money, and that financial institutions play a smaller role in the money supply compared to the market for loanable funds when you're talking about long-term real interest rates. Those are the interest rates that have been adjusted for inflation, nominal minus price level. So rightward shift to supply. If you had a lot of foreigners that decided to invest their currency into the US, so you see a large inflow of foreign money, that can also increase the supply of loanable funds, which would be good for long-run growth as it brings down real interest rates and encourages more investment, hopefully in research and development projects, which would grow capital stock. The other classic way to use the loanable funds market, like I mentioned before, was our favorite crowding out effect. Remember, if the government, so not monetary policy, not the central bank, but if the government, through fiscal policy, is increasing its spending or cutting taxes, it needs to borrow that money. And that's where it goes to the loanable funds market. So if the government has to run a budget deficit, it does not have enough tax revenue to meet its spending programs, then it borrows. It runs a budget deficit. So there's two ways that you can view this. In the top left, if the government increases its borrowing, it demands more loanable funds. That would bring real interest rates up, which would mean it would be more expensive for households and businesses to borrow. And that could be harmful for long-term economic growth. The bottom right, same idea, except we're viewing it from a supply perspective, that if the government is increasing spending and cutting taxes and it's borrowing more from the private sector, then there's a less supply of loanable funds that's available for businesses and households, which also brings up the interest rates. The important thing here is that if you're working with an expansionary fiscal policy, real interest rates will rise, and that's bad for long-term growth. However, that expansionary policy can be good for short-term aggregate demand. Right, here's a Phillips curve. The Phillips curve is similar or has a very important links to the ADAS model. We look at the price level on the y-axis, which is the inflation rate. You might notice that just about all of these diagrams, the price of something is always on the y-axis, whether it's the price of money with nominal interest rates or real interest rates in the loanable funds market, or just the price level in the ADAS market. The price variable is always on the y. The only exception would be the production possibility frontier, which is looking at the output of products. So the inflation rate is on the y-axis, and then we have unemployment on the x-axis, the rate of unemployment. So the 5% unemployment, we're assuming in this model that that's the natural rate, the NIRU, the non-accelerating inflationary rate of unemployment. So the long-run Phillips curve is vertical at the natural rate. Now, because we're always at the natural rate of unemployment, we're always fully employed in the long run, we have the vertical, the perfectly inelastic Phillips curve at the NIRU. Now, if we're in the short run, we might be operating at a point that's to the right of the long-run Phillips curve or to the left of the long-run Phillips curve. So we would have a recessionary gap if we have high unemployment, so meaning we have a demand shock style recession. If aggregate demand shifts to the left, then we are at the point that says REC, recessionary gap. If aggregate demand from a fully employed economy suddenly increases, we have a positive demand shock. We would have demand pull inflation. We'd have low unemployment but high inflation, and we would be at point INF. This was that thing where when aggregate demand shifted one direction, we moved point to point the opposite direction on the Shortrun Phillips curve. So remember how those two models, they work those opposite directions, opposite ways? If aggregate demand goes to the right, we go point to point to the left on the Phillips curve. There you go. Rightward shift of AD. It's point to point left. And a leftward shift of aggregate demand is point to point to the right. Word. If there's a shift in the short-run aggregate supply curve, then there's a shift of the short-run Phillips curve. So this can happen as an economy self-corrects in the long run. So if there's a leftward shift of aggregate supply, we have higher prices and higher unemployment. We would call that stagflation. This would be an example of stagflation as shown by the Phillips curve. So a leftward shift of aggregate supply is consistent with a rightward shift of the short-run Phillips curve. If we have a rightward shift of aggregate supply, say a positive supply shock, or if the economy is self-correcting in the long run from a recessionary gap, the aggregate supply goes to the right, which means that prices are low, and unemployment would decrease as output's increasing. That's a leftward shift of the short-run Phillips curve. All right, final little diagram for this week. This is a really awesome interest rate chart that's in the top 10 guide, the Noble guide, the top 10 guide toward the end. There's a copy of that PDF on the Google Classroom. It should be like the very first thing that I ever uploaded to our Google Classroom in the beginning of the year. This is one of the most important charts, I think, that could help you for understanding the basic relationships that you encounter on the macro exam. So if interest rates go up, you follow the flow on the left. Higher interest rates reduce private sector spending, which would reduce aggregate demand. When interest rates go up, bond prices fall. Inverse relationship between interest rates and bond prices. I mean, you can imagine that as interest rates rise, money's more expensive, so people can't afford to purchase as many bonds. So less demand for bonds brings down the prices of those bonds. When interest rates are high, that's bad for long-term growth. The capital stock formation slows down, slows growth of capital stock. That could be bad for the production possibility frontier. That could be bad for long-run aggregate supply. And then where we left off at the very end of macro, we talked about how when it comes to interest-bearing assets, when interest rates are high, people that are outside of our economy, outside the economy, foreigners, want interest-bearing assets because they'll get a higher return on them. So as interest rates increase, there's more demand for bonds in the international sector. Currency price increases, which means that the currency appreciates. And with a stronger currency, appreciation of a currency, the net exports would decrease. So while they're probably not going to ask you to draw the foreign exchange market, they might ask you about that relationship of how currency value, the appreciation or depreciation of currency, affects net exports, which would therefore affect the ADAS model, aggregate demand. The right side of the chart showing how interest rates, they decrease, then you have everything opposite. Lower interest rates encourages more consumption and investment, private spending, so more aggregate demand. When interest rates decrease, bond prices rise. So you can imagine if the Fed is increasing the amount of bonds it's purchasing, so it's buying more bonds, it's more demand for bonds, that causes interest rates to fall, but more demand for bonds causes the price of bonds to rise. So there again, there's that inverse relationship between interest rates and bond prices. Lower interest rates are good for long-term growth, encourages more research development, capital stock formation, long-run growth. And when interest rates are low, there's less international demand for bonds and currency, which depreciates the value of currency, which increases the net exports and therefore increases aggregate demand. All right, so that's enough for this week. Just a quick little recap of our macro graphs and some important relationships. I'm going to assign a good old free response question or whole free response set to do in macro for this week. We haven't done that in a while. And also a couple more Noble review packets to help solidify and reinforce the key components of AP Macro, because we need fives. This year we're all about the fives. Like I said, I expect to buy a brand new podium next year. An extra 3 feet of name should be on that podium. Double fives. I'll see you later.